Welcome to the module Understanding Fibonacci Retracements. This is another tool in our box which is pretty useful in determining whether we've got a bona fide trading opportunity or not. Now, a lot of people have hang-ups about Fibonacci and put it on this pedestal just because it sounds Italian, it sounds fancy, it's spelled a little bit differently, it's got more than 2 syllables. However, it's just a minor tick in the box to us, and I just want to demystify a few urban myths which we've been getting time and again from our clients. But first things first, we want to tell you exactly why we use Fibonacci, and it is a useful tool for objectively ascertaining the percentage that price action has retraced before the continuation. And we could do this in trending markets, so it's a fantastic accompaniment for trending markets. We can't use it in range-bound markets, really. As I just mentioned, it's useful for predicting the point of continuation, which we call phase 1, of the trend after a period of retracement, which is phase 2. It is also useful for identifying hidden levels of support and resistance, and believe me, there are quite a few based on Fibonacci levels, which we'll illustrate to you soon. And if used correctly, it provides us with objectivity and order with a market which is essentially chaotic randomness. Now, I'd like to heavily emphasize to you that it's very frequent that Fibonacci retracement are used incorrectly. They're dragged from the wrong price point to the wrong price point. And essentially, we're going to teach you the right way of doing it so we can get full objectivity to the point where we've got a legitimate Fibonacci number validating our trade. So the Fibonacci retracement tool essentially enables to measure the percentage, which just happens to be based on Fib numbers, the price has retraced against its prevailing trend. So we want to establish, based on percentage terms, which happens to be Fibonacci numbers, the percentage phase 2 might have occurred, and we can use this in addition to preempting when phase 1 is going to continue its dominant downward trend. It gives us essentially a good idea or a good heads up as to when we can reasonably expect the dominant trend to continue its direction. And there are lots of Fibonacci numbers out there, but the ones we simply use is the 0.382, 0.50, which isn't actually a legitimate Fibonacci number. It's just a psychological number which corresponds with the phase 2 retracing 50% of the way. We also use 0.618 Fibonacci number and 0.786. Now, the 0.786 for us is the last chance saloon, or the last Fibonacci number we can really have until we can reasonably say that Fibonacci is invalid if price action breaches a 0.786 number, that is. But these are the key numbers we would encourage you to have on your Fibonacci. Wouldn't really worry too much about anything like the 0.25 or the 0.25 Fibonacci level or the 886 for now. But the smaller the Fibonacci number gets played, the shallower the retracement is said to be. And on the flip side, conversely, the bigger the number which price action interacts with, the deeper the retracement is said to be. But as we just mentioned, for Fibonacci retracements to hold any validity or meaning whatsoever, it needs to be used correctly. And the point of this module is not only to really show you exactly why we use Fibonacci retracements, but also give you a hands-on tutorial as to how we use it and how not to use it. Okay, so as you just mentioned, we only really want to use Fibonacci retracements in a trending market, up or down. So for an upward trending market, we want to see cyclicity making higher highs and higher lows with peaks and troughs like so. It doesn't necessarily have to be conforming to a trend line, but as long as we've got clear peaks and key troughs, that's what we can classify an upward trending market. We can use Fibonacci in this way. And also in a downward trending market, we could also say exemplified with lower peaks and lower troughs, lower highs and lower lows. It doesn't necessarily have to be conforming to a trend line. I know we've got one here, but we can use Fibonacci for just a trending market period. That's where Fibonacci retracements work best. Like, for example, here. So first things first, here is an example of how to use the Fibonacci retracement tool in a downward trend. What we'll do is quite literally drag the Fibonacci tool from the points where the move first occurred, from the edge of the cliff. We'll drag it to the low point. and plot it this way so that we have our fib numbers already plotted on the graph for us so that we can see to what extent, what percentage based on Fibonacci number, we have price action coming back. In this case, we can see that price action is high tested off the 50% Fibonacci level, like so. And this level just so happens to correlate with a horizontal level as well, which is a fantastic confluence of factors. And that's what we look for. Okay, we might have a Fibonacci interaction with price action, but if it's correlated with something else, it makes it a much better trading opportunity. So just to recap, as mentioned here, in a downward trend, we simply want to take the Fibonacci tool from the most recent swing high to the most recent swing low in order to project the zone where we can reasonably expect price action to turn around and continue its downward direction. And if it's correlated with another technical level, like a horizontal level, a moving average, a big number, then absolutely fine. And we can see here that we've got a rejection of the 50 moving average here. And I know this level has been broken, but it's been respected a few times as well. 1, 2, 3 times. As support is broken through the support level and it's retesting as resistance. And this is a real kind of like hallmark of a downward trend. When we've got old support being broken, whether it's hard or soft support, and it's being retested as resistance, and we can reasonably expect, based on a Fibonacci number as well, that we can get a continuation there afterwards. And conversely, in an upward trend, what we want to do is we want to take the Fibonacci from the most recent swing low and take it all the way to the most recent swing high in order to plot the Fibonacci number or level where price action is likely to retrace to before continuing. Like in this instance here, we've taken the Fibonacci retracement from the beginning of the move to the extreme high. And we can see here that it's come back to 0.618 and it's come and rejected off it before the continuation. And this was on Kiwi on the 17th of March. It came down to the 0.618, which is quite a decent Fibonacci number. You'll quite often see price action retracing back to the 50% or 0.618 Fibonacci numbers before continuing. And then we can take it long. Preferably if we have other reasons to get into it long. Just a word of advice, we would never actually get into a trade based on a Fibonacci on its own. We repeat, we do not ever get into a trade based on just a Fibonacci number alone, purely because it's too flimsy. Whenever we decide to get into a trade, it's like building up a case for an argument or a debate, like the politicians in Parliament. We're gauging the evidence, we're looking at a number of factors before coming to our argument. Do we take the trade or do we sit back and be a pilot on the ground wishing heels in the air rather than the pilot in the air wishing heels on the ground? So we can use Fibonacci retracements on any time frame you want, whether it's the hourly, 4-hourly, daily, weekly, even monthly. But you can be rest assured that the harder time frame you use your Fibonacci retracement on, the more reliable it's going to be, the reading. Just in the same way that the hard time frames give us a little bit more reliability when it comes to horizontal levels and moving averages. It's essentially because more people are watching the hard time frames who know what they're doing, and the hard time frames have stronger structure and are less susceptible to news events, which unfortunately beleaguer the smaller time frames, which quite frankly tend to be a little bit noisy, for us at least. That's why we only trade the daily time frames, so that you can have a peaceful and reliable and high probability with high reward. So anyway, this is Fibonacci retracement on the cable. So let's see, with regards to the credit crunch, which started here all the way back in 2008, just the beginning, towards the end of 2007 as well. We can take our Fibonacci retracements from the very start of the move downwards, when all hell broke loose, like so, the edge of the cliff, take it all the way to the very bottom, the low, and we can see quite clearly, having plotted our Fibonacci retracement tool, that apart from one instance, the 50% Fibonacci number has been very well played here. And it hasn't really been able to make a meaningful breach above the 50% Fibonacci number. And this correlates with this example here, big number, 1700. If we draw this level on, like so, 1700, or 27 just about, if you see the 1700 right here on the right hand side, we can see, if we look even on the monthly, that our 50% Fibonacci level correlates with a sell zone here. With this level, 1700, going as far back as 97, 98. So you can see here that, quite frankly, price action is very unlikely to breach this concrete wall in the way, or two concrete walls in the way. Not only do we have the Fibonacci number, we have the level and the big number. But that was then, this is now. Let's have a look at some other examples. Let's look for currencies which are cycling. So we have pound Swiss here over summer 2012, and we can see that it's cycling very nicely, making key higher highs and higher lows like so, with higher peaks and higher troughs. It's respecting the 50 moving average, absolutely fantastic. It's nice and steep. However, what about our Fibonacci retracement number? Well, what we can do is we can simply plot the Fibonacci retracement from the most recent swing low, like we just mentioned, to the most recent swing high here, and we can see that it's actually bouncing off the 0.618 Fibonacci level. And regardless of Fibonacci numbers, we can say that it's actually retraced back 61.8% of the way from the start of the move. So we can anticipate, given that it's not only on a Fibonacci number, 0.618, it's also on a well-respected 50 moving average. We could classify this as a potential trading opportunity for that reason. We can also use what is known as a Fib cluster if we decide to take it from a different swing low, and we can do that very easily. So for example, we took it from this last swing low to this most recent swing high. However, if we take it from the swing low before the last one and take it to the most recent swing high, we can see that it's actually respecting the 0.50 Fibonacci level as well. So we have what we can refer to as a Fibonacci cluster, where we get an overlap of Fibonacci levels when drawn from different points. So I know it looks a little bit complicated here, a little bit confusing and cluttered, but we've got not only is the current price respecting the 50% Fibonacci level, it's also respecting the 0.618 when taken from different points. In an upward trend, that's okay. Take the Fibonacci from different points. If you get overlap, absolutely fine, but make sure the swing high you drag the different points of swing lows from is constant. It's the most recent swing high. That's absolutely crucial in this. So we're just going to recap on the Fibonacci cluster because we know it's relatively new to a lot of people. So we take our first Fibonacci from the last swing low here to the most recent swing high up here. And we can see that price action is respecting the 0.618, absolutely fantastic. However, we want to see if we've got even more overlap and a Fibonacci cluster where we've got different Fibonacci numbers drawn from different points aligning themselves with each other. That's a stronger setup than if it was just a random Fibonacci number on its own. So what we could do is take it from the next swing low down and take it to the same place as we did last time. And we can see that not only does it correlate with the 0.618 level, it also corresponds to the 50% Fibonacci retracement level as well. So this, based on Fibonacci, makes this a much stronger setup. We could even take it from the very bottom here, the start of the move upwards, and take it to the top. It's a little bit far-fetched. We haven't really got, it hasn't come back to a Fibonacci number here, so we can just forget about that. So you can see that if we've got a Fib cluster, we've got an extra reason to get long, and our activator bar here, if we did decide to go long, has more strength behind it because it's aligned itself with more technical factors, like two Fibonacci numbers. It's got a 50 moving average here. It's also bouncing off the previous swing high here. And dare I say, a trend line like so. And this is where we take all of our technical tools and put them together in the great soup that is technical analysis, when we're looking for as many confirmations as possible in order to validate our trading decisions. So trend line here, we can see the moving average is respected, the 0.618 Fibonacci number, and also respecting from a different level the 50% Fibonacci number. So we've got a Fibonacci cluster. So 4 reasons to go long. Not bad, hey? But just to reiterate that Fibonacci retracements work best and as objectively best in trends which are obvious. And if there's any ambiguity about the cyclicity or the trend, then why bother, quite frankly? We want to take them from key swing lows to swing highs in an upward trend, or key swing highs to swing lows in a downward trend. Let's take the cross-currency pair Euro-New Zealand, for example. We can see that we've got fantastic cyclicity here. We've got lower highs and lower lows, lower peaks, lower troughs, lower peaks, lower troughs, lower peaks, which is fine. We could probably get a trend line out of that as well. Just about. However, let's get rid of that. However, what about Fibonacci? If we take our Fibonacci from this swing high to this swing low, we could reasonably expect this one to correspond with a Fibonacci number. If it does, great. If it doesn't, no biggie. Oh, it doesn't. That's fine. No problem. However, if we take it from this swing high to this swing low, like so, we can see that we've got the 50% Fibonacci level respected here. So it likes to look at the 50% Fibonacci number, so we can reasonably expect when price action has made its lower low, like it has, and comes back, we could expect that it's going to turn at the 50% Fibonacci number, or at worst, the 0.618. Quite frankly, looking at this, we can see this 0.618 Fibonacci number actually corresponds with a level here, like so, not a round number, but just a level which has been previously respected. And if we draw a trend line in, aligning these 3 points, or 2 points and a potential third, we can see that price action could potentially interact with this horizontal level, the 0.618, and this trend line in this sell zone roundabout here. So we can essentially, you can see how we got Fibonacci retracement already mapped on our charts already in advance of price action actually interacting with it. We've got the luxury of being in this position here. We just need to be patient. Sit back and wait for our enemy to come into our trap. Any of you who've read the book The Art of War by Sun Tzu, there's quite a few parallels there to trading, and one of the key premises is the war is won before it's begun, and that's a real parallel to trading with regards to people who do their technical analysis beforehand and look for correlations and do their groundwork generally do a lot better than people who don't. Simple as that. They plan a set of eventualities that could potentially happen. They look at the probabilities. They wait for price action to jump through a set of hoops for them. If they get a setup which meets all their rules, they'll take the trade. If they don't, they'll sit back and take the day off or the evening off. For most professional traders, it's very black and white. Either the trade meets their rules based on a certain number of criteria, or it doesn't. If it does, the trade's taken. If it doesn't, they move on. We'll just take a quick look at dollar Swiss now. We can see that it's cycling upwards. It's making higher highs and higher lows, although it's quite a gradual trend, unfortunately. However, what we can see here, despite this upward cyclicity of higher peaks and higher troughs, is we can look at the current cycle. We can say, okay, well, if we take our Fibonacci number from the last swing low, like here, to the most recent swing high, like here, is actually respecting the 0.618 Fibonacci level here. So from this move here to this move here, it's traced 61% or 61.8% of the way before we can reasonably anticipate a continuation. And what is interesting here is this Fibonacci level of this buy zone doesn't quite overlap perfectly, but we do have a zone here where if this low test bar not only tests this horizontal soft level which we've identified, but also closes above the 0.618, then we've got a decent multiple test here and a potential buying opportunity, whereby we've got respecting of the 0.618, providing the day we're looking at closes above it, and also the testing of this horizontal level, which is actually a very good confluence if you're looking at trading with the trend here. One could even argue that we actually have a trend line as well if we just plot it on like so, from this point to this point to this point, like so. So you can see how we're building up the case for a potential long trade here. Not only do we have a Fibonacci retracement to the 0.618, we have a horizontal level, we have a trend line bounce. That's not bad really. Not bad at all for a confluence of reasons in support of a long trade. And if we get a low test bar on this day, then fantastic. We could potentially look at going for a long trade with a decent amount of probability behind it. So let's now take a look at Kiwi dollar. We can see here that it's making lower highs, and we currently have a high test bar. So we can deduce from this that, okay, a high test bar is pretty bearish. We do have actually a trend line here. If it closes below the trend line, then we have our third touch, which is good enough. But how about our Fibonacci retracement? Well, let's show you. Take our Fibonacci retracement from the most recent significant swing high, which is this point here, and take it down to the most significant swing low. We can see that it's currently respecting the 0.786 Fibonacci number here, which is a very decent number indeed. It's at the last chance saloon in Fibonacci numbers. So you can see quite clearly that we've not only have we got our Fibonacci retracement, but we've also got another reason to potentially take this trade, which is what we want essentially. The more reasons, the better. And as I said before, we don't just want to enter a trade based on a Fibonacci number. We want another reason, whether it's a horizontal level, a trend line bounce. So we've got one Fibonacci number here. It's respecting the 0.786 that we just illustrated. However, if we take it from this swing high here as well, and take it down to the bottom, do we have a cluster, which is where we get the price action overlapping with multiple Fibonacci levels? No, we don't. In order for us to get a cluster, we'd want our fib to be taken from this swing high to this swing low, the lowest point, and for the high test bar to be interacting with a Fibonacci number on the new fib we've drawn, but it isn't doing that, unfortunately. However, that's fine. To be respecting one Fibonacci number from the most recent move down and move up is absolutely okay. No problem. And the fact that it's corresponding with the trend line as well is a bonus, but we just want today's bar to be actually closing below the trend line. That's the crucial element to it, because if it closes above the trend line, then the trend line is invalid. So I'm sure at this stage we can see how we're actually combining the different tools in our toolbox in order to build up a clear picture as to where we can reasonably expect price action to go next based on the number of tools which say the same thing. We can actually see a very similar kind of setup on cable. We've got a high test bar here. If we take our Fibonacci retracement tool from this swing high, take it to the swing low, we can see that the current test bar is actually respect to the 0.786 Fibonacci level, i.e. it's retraced 78.6% back from the initial move down here before we can see a continuation. But we wouldn't want to enter this short just based on this. We want to look for other evidence as we build up our picture. Are we corresponding with a trend line like we were with the Kiwi? Yes, we are. Do we have a horizontal level, which we didn't have with the Kiwi? We do have a soft level here. We can see how we've had this horizontal level testing currently, tested all the way back in October 2011, May 2011. If we scroll back, we can see as well that it tested all the way back in 2009, So we've got 3 reasons to take this short. We've got a strong level of support here. We can see that we've got lower highs and lower lows, or lower peaks and lower troughs coming into this level of support. So we could reasonably say that based on probability, if the bar in question closes and interacts with this 0.786 Fibonacci level, high tests, and is also rejects the trend line and the horizontal level like it is, that we could expect a move downwards. But we need to wait for the close of the bar. That's pretty important. What is interesting with cable as well, if you want to go fib confluence, is from this swing high here to this swing low. If we drag it and take it down to the bottom, like so, we are just shy of the 0.786 Fibonacci number in this instance, previous to it falling and collapsing like it did. So that's giving us an extra reason to potentially get short here. History repeats itself for the markets, it really does. And what is more, with this new Fibonacci level which you've moved on, or drawn on, we can say that we have a cluster. Because while the most recent swing high to swing low respects the 0.786 here, if we take this off, and we can take the Fibonacci from this swing high to this swing low, the current test bar is respecting 0.618 from the swing high to the swing low before the most recent swing high to swing low. So this is a cluster potentially in action for a short tonight. You can see how the 786 Fibonacci level of the most recent swing high to swing low overlaps near perfectly to the 0.618, which basically is a Fibonacci level as a result of the swing high to swing low before the most recent one. So that's a wrap for Fibonacci retracements. We wish you well.